Uh, Good afternoon. Welcome to the Apex Private Wealth Client webinar. A lot has happened since our last webinar, which was roughly a year ago. We've had some new additions to our team. Renee joined us in November last year from R&B Wealth. We are very excited to have him join us, most importantly because he has the same clients first kind of mentality that we take so seriously. He's also bringing a lot of new ideas that's adding some depth to our advice offering. You'll meet him a bit later in the Q&A portion of the webinar. We've also had Colleen and Eloise join our administration team earlier this year, and Julia started her CISA internship with us in March. As independent wealth advisors, we hope to be the link between you and your investments, looking at all products, asset managers, suppliers out there, and matching you with the best portfolio possible. We are free to use any provider, any fund, any investment manager. So this allows us to be unbiased and impartial. Here, I'm just put up our investment process. I'm not going to go into it in too much detail, and if anybody wants a copy of this, we happily send it to you. This outlines some of the process that we follow to get to the select group of funds that we use from the thousands that are available. We do some extensive internal research as well as by external fund research from Fundhouse. We do quants analysis to blend different styles of funds together to get a combination that will hopefully give superior returns, but with less volatility. Some of the key things that we look for are track record, a stable team, a thorough research and decision-making process, as well as transparency and competitive fees. Over the past few years, we've also added to our service offering. We now also help clients with wills, trusts, estates, tax, and family and business structuring. Something I've noticed visiting clients over the past few months is that I think this is probably the most negative I've heard people be in South Africa, especially. Load shedding, high inflation, interest rates, the exchange rate, corruption, Russia, unemployment, they're all weighing on our moods and our feelings about the future. But I'm hopeful that where we are now is maybe the low point of our pessimism. And thankfully, investment markets are forward-looking, and with the first signs of improvements over the next few years, we're optimistic that investments should do well over the next few years. I want to end just by thanking all of you for your support and trust over the past year. We often tell people how grateful we are to have the types of clients that we do, and it's thanks to you that we enjoy our work, and hopefully this continues into the future. We are also very proud to have received the Wealth Management Firm of the Year award at the Prestige Awards earlier this year, especially since feedback from clients and the industry regarding ethical practices and our advice and service excellence is a key part of that award. So thank you for your support for that. I'm now going to hand over to Brandon. Thank you.
Thanks, Drew, for that. I'll now be introducing the star of the show and the reason why you're all attending today's webinar, Kevin Lings, Chief Economist at Stanlib. With his extensive experience providing economic research and analysis to the asset management industry in South Africa, Kevin Lings is renowned for his expertise in the field. As a sought-after media commentator and published author of journal articles both internationally and locally, his knowledge is highly regarded. During this webinar, Kevin will delve into the most significant topical and macroeconomic themes affecting both South Africa and global markets. This will allow you to gain valuable understanding of how these factors impact you as investors and the financial landscapes which we consider. In addition, this webinar will provide you with the unique opportunity to engage with Kevin Lings via our Q&A segment at the end of the presentation. During the presentation, please feel free to type in any questions you may have in the Q&A box seen at the bottom of the screen. My colleague Renee will then deal with the most common questions or themes which have been raised during the webinar. If we are not able to get to your questions today, we will respond to you privately in the next few days. Before I hand over to Kevin, I will now ask you to participate in a quick poll, which would have popped up on your screen. I will give you a few moments to select the relevant response. Once we've done that, we will then move on to handing over to Kevin. Please take a few moments while the poll is up. Thank you for participating in the poll. I now hand over to Kevin, who will continue with the rest of the presentation.
Thanks, Brandon. Afternoon, everyone. Let me get my presentation ready. I think it's open. Geez, there's a lot going on locally, internationally, and obviously we're going to try and deal with most of that during this discussion. I tend to use a fair amount of charts as I go through it, but I try and keep the charts fairly simple. If there's something that I'm really not explaining as I go through the discussion, please just interrupt me. I don't mind being interrupted. Otherwise, we can take questions at the end. Also, if you want a copy of the presentation, we can make it available to you. So if you want to look at it later on or refer to it or use it for something or other, that's no problem. Or if you've got something else later that occurs to you and you think, geez, I really don't understand that, then just reach out. We can try and provide some understanding, or if it's data, whatever you're looking for. So as I said, there's a lot going on. Obviously, in South Africa, the situation has been challenging. It's fairly depressing when you get into the economic data, but I do think that we're at the point of maximum pessimism. I would regard a couple of weeks ago as actually that point of maximum pessimism, and I'll try and explain why. It did correspond with us being accused of loading ammunition onto the Russian ship. That, I think, was part of it. The currency going up to 19 Rand, almost 20 Rand. I think that was part of it. A lot of investor nervousness around that time, a lot of load shedding around that time. I think there was a convergence of factors that kind of came together. And subsequent to that, there has been some improvements, but I think I'm optimistic that there will be further improvements in SA going into next year. So quite strangely, I've been revising up my forecasts for next year. Although this year still looks incredibly bleak, I do think there is some room for improvement. And I think maybe to bear in mind from an investment point of view is, as we go through the discussion, I think a lot of the bad news is priced into our markets. I think our markets are relatively cheap. And I would reference pretty much all of it. So I think the currency is cheap. By that, I mean it's undervalued. The fair value for the currency sits for me at about 17 Rand 30. That doesn't mean that I think the currency is coming back to 17 Rand 30, but it gives you some idea that the currency is undervalued. So I think the currency is cheap, relatively speaking. I think equities are cheap, particularly South African equities. By that, I mean companies that earn most of their money in South Africa. And then I think bonds are cheap. So if we do get some improvement in economic growth, some improvement in, or further improvement in inflation, interest rates start to get cut, then I think there's some upside in our domestic asset classes. So I would urge you maybe just to reflect on that as I go through the discussion. Obviously, we've got to get to that point where there is upside. So it's not an absolute given, but there are a range of factors that are moving us in that direction. And I would say internationally, I'm also optimistic that as we go through the course of next year, there will be some improvement. Although when you look at international markets, they're not necessarily cheap, right? So certainly if you look at US equities, the bulk of US equities are quite expensive. So you may find, and certainly it's our view, that during the course of next year, some of the emerging market assets will be quite appealing. South African assets could be quite appealing for foreign investors who are looking for cheap assets, who are looking for opportunities. So it's something we certainly focused on. I don't think the time to move into markets necessarily aggressively is right now, because you need a bit more evidence that it will get better. But it's, from my perspective, that's the focus. All right, so what we're going to do is we're going to look at the US in a bit of detail, and then we'll look at South Africa. Along the way, we'll discuss inflation, interest rates, growth. We'll talk about Russia. We'll talk about a bit about China. We can talk about the BRICS, and hopefully give some sort of context for what's going on. And I'll refer to some other countries, although I'm not necessarily going to delve into it in a huge amount of detail, just because we just don't have the time. So let me put up my presentation. Okay, so I'm hoping you can see that. So in essence, the key discussion point globally has been inflation. It's a bit of a boring topic, but it's been a major theme now for the last 18 months, maybe longer, 24 months. And it's come about because of a range of factors. It's not as if it's just one thing. I mean, obviously, there are some factors you can point to that's caused global inflation. But I would say it's a convergence of factors. Certainly, the Russian invasion of Ukraine heightened some of the food pressure and some of the global concerns around food supply, and that definitely accentuated food inflation around the world. So that's one factor. The other factor, undoubtedly, some of the supply disruptions that followed COVID. And I think most of those supply disruptions have now worked their way through the system. But the fact that you did go through that phase where you were struggling to get items and shipping costs were going up, etc., I think that contributed. The oil price at some point, definitely a big contribution. And then the stimulus from the major economies, especially the United States, where it's not just that you had exceptionally low interest rates, it's that you were printing money and putting a huge amount of money into the economic system and giving a lot of money to households who then spent. So I would say it's a convergence of factors, pushed inflation up around the world to over 9%. And if you look at the recent history of global inflation, it's been nothing like that in recent years. You have to go a long way back to find an inflation rate that is similar to this. And obviously, central banks were caught out by this. Central banks didn't anticipate this. And when inflation started to become a problem, they tended to react very late. They left their reaction too long. And so when they did start to react, when they did start to put up interest rates, they found that they were behind, that they had to play catch up. And that's always an awkward time, right? Because now you're having to rush interest rates up. You're having to catch up with where interest rates really should be. And clearly that has been a problem for many economies, because you've had to deal with very aggressive interest rate hikes in a very short period of time, and therefore adjusting to those interest rate hikes has been problematic for households, problematic for businesses. And we still got to experience the pain of what the interest rates mean. In South Africa, I think we haven't worked out quite how much pain interest rates are going to cause. They've caused some pain, but they're likely to cause more pain. And I think internationally, it's exactly the same. So we still need to digest the economic slowdown as a consequence of higher interest rates. And that's unfortunately ahead of us. Now, there's some evidence of that slowdown around the world, but in all likelihood, it's going to continue to slow. And that's why I say when you look at a more optimistic scenario, there's still a lot of bad news we've got to get through before we get to that optimistic scenario. And we just try and bear that in mind. It's not as if there's some sort of magic solution. We've got to get inflation under control around the world. Then we've got to cut interest rates, and then we start to get into a better economic upswing. And hopefully that is accompanied by a revival in asset class performance, especially in emerging markets like South Africa. So inflation's coming down. So the interest rates have started to work. That inflation hasn't come down dramatically. It's still got a long way to go. And most countries sit with an inflation target of 2%. And many countries are far away from 2%. And so you get a sense that that inflation target will probably only be met during the course of next year. We'll make more progress in the second half of the year. We'll get closer to the target. But in terms of reaching that target, probably only next year, which then says that interest rates are going to have to remain high or elevated for all of this year and only start to get cut next year. And I think that applies to most countries, including South Africa. But markets are forward-looking. So as soon as markets get a feeling that this is as bad as it'll get, that interest rates have peaked, that inflation is going to continue to moderate, and that they start to look forward to when the interest rates will ultimately get cut, then markets tend to respond to that. I don't think we're at that point just yet. I think we're getting closer and closer, but I don't think we're there right now. We need more evidence as to how this is all going to unfold. And so we're kind of in the thick of it. And we're looking at a wide range of data to give us some idea of, firstly, when does inflation moderate more meaningfully? Secondly, what is the economic consequence of the higher interest rates? And third, when do interest rates start to get cut? And where do they take interest rates when they start to cut them? So quite a number of issues. The focus remains, as I said, the US. And the reason is the US just dominates. They dominate financial markets. They're still the largest economy in the world. China's obviously catching up. And at some point, you would imagine that China will overtake the United States as the world's biggest economy. But it's not there yet. And in terms of equity markets, bond markets, the currency, the US just continues to overwhelmingly dominate. There has been some discussion around de-dollarization, this idea of, I don't know, the BRICS launch some currency and that starts to gain traction and it unsettles the dollar in a sense, or that the Chinese currency gains more traction and it eats into the dominance of the dollar. Just a quick comment on that idea is so far, no, that hasn't happened. The dollar is as dominant as it's ever been. There's lots of data over many decades, and the most recent data we've had is for last year, up until last year. There's no loss, there's no weakness in the role of the dollar in the global economy. There's been some improvement in the role of the Chinese currency, but if you look at each share of the currency market, it's still very, very small. And at some point, there was a discussion about the euro taking over and euro kind of rivaling the United States. That hasn't happened. The euro is meaningful in terms of its trade in international currencies, but it certainly hasn't eaten into the role of the dollar. So there's quite a lot that would have to happen to unseat the dollar from the global reserve currency. And I don't think that's about to happen. And part of that is just psychological. Most people trust the dollar for whatever reason. That's quite difficult to unpack because the US economy itself does have problems and significant problems from time to time. And the leadership of the United States is certainly far from impressive. But yet people love the dollar. And that love for the dollar, the trust in the dollar, the willingness to hold dollars, that's been unwavering. And I think it will take a lot to unseat that. And I'm not expecting that to happen, certainly over the next number of years. So the dollar remains incredibly dominant. So we focus on the US a lot. I probably spend more time looking at the US than I do on South Africa, just because it dictates the mood in international markets. So US inflation got to over 9% in the middle of last year. That was the peak versus a target of 2%, so massively above their target. And they've been bringing that down, and the US inflation rate is now at 4%. So that's significant, right? It's come down quite a bit, but it's not at the 2%. And that's what the Fed's got to get to. They've got to get this down to 2%, or they've got to be very confident that they will get to 2% before they can start to cut interest rates. And so most central banks around the world are living with very high interest rates and will continue to do that for many months, even though inflation is moderating, because you've got to be sure that the inflation rate is going to continue to moderate. And what you don't want to do is give up on that fight against inflation too early. That would be hugely problematic, because then what will tend to happen is inflation comes back, it starts to become a problem, and now you're starting to cut rates, and then you find, geez, I've cut too early. You have to then go back and resume interest rate hikes, and that's very problematic for most economies, very disruptive. And it does lessen the credibility of the central bank. So you don't want to mess this up. What you would rather do as a policy is tighten interest rates too much, over tighten interest rates, make sure that inflation's coming down, because you can always cut interest rates very quickly. That's easy to do, and you can provide that relief very quickly. But if you haven't got inflation under control, then it can end up being a long, dragged out process that is harmful for the economy for many years. So I think you're going to see the central banks keep rates high well into next year. I don't think you're going to get an early interest rate cut. There are no major central banks that are cutting rates. The only country that is cutting rates is China. And even there, they only cut 10 basis points, 0.1%. And they don't have an inflation issue whatsoever. Their inflation rate is incredibly low, and they actually risk going into outright deflation. But outside of China, nobody's cutting interest rates. Everybody is either keeping rates very high or continuing to hike interest rates. So let me show you the coordination between the major central banks. So I've just got the US, Euro area, and the UK on the chart, and you can see how they've all moved up to a similar extent over the last, let's call it the last 9 months, the last year. And the move has been aggressive. This is a very rapid increase. It's a catch-up. It's recognizing that inflation is a problem, and so you're kind of rushing interest rates up. And so you would say that they've done most of the work, right? I don't think interest rates go up dramatically further from here. I think interest rates go up slightly more. The US, we're saying another 25 basis points, 0.25%, possibly 0.25%, but then we think at the top of the interest rate. I think Europe will go above the US interest rate, so they've got a couple more hikes to put through. The UK also equally, a few more hikes to come. But the bulk of the interest rate increases have already occurred, and so you're searching for where is the top of the interest rate. I think most countries reach the top of the interest rate within the next 3 months, and then keep rates unchanged for the remainder of the year, and then consider cutting interest rates around the middle of next year. And once you cut interest rates, that signals that you're going to start to go into the next economic upswing, because you can cut rates quite quickly and you can start to get an economic revival. So that would be seen as a very positive outcome once inflation's under control and once you start to cut rates. Markets will move ahead of that. Markets won't wait for that all to happen, before there's more exuberance, especially in emerging markets. And so we're looking for those opportunities. As I said right up front, I think it will materialize. I don't think it's quite there yet. So what do we need to see in order for US inflation? Let me just remind you, US inflation is down at 4%. What needs to happen for US inflation to be down at 2%? Well, they need to keep interest rates where they are or higher for a long period of time. So that's part of it. And then the other part of it is they've got to get this number down. This number is shelter inflation. Shelter inflation is just a fancy way of saying housing inflation. It's think of it as the cost of renting a house. And you can see what this number has done. It went to over 8%, and it's the single biggest part of the US inflation basket. It matters hugely in the United States. And this number went up this high because of all the stimulus, right? Interest rates were incredibly low. The government was putting a lot of money into the system, and there was a lot of demand for property, and property prices went to an all-time record high. And so the cost of renting and the cost of owning property went up. And as a consequence, inflation for housing went up dramatically. But because this is such a big portion of the US inflation basket, the US can't get to the 2% target. They can't get inflation down to that 2% unless this number moderates meaningfully. And so that becomes the key focal point. You've got to get housing inflation down. So far, you can see if you look at the chart at the end, it's kind of turned over, but it's hardly convincing, right? It suggests that there's some progress, but a lot more progress has to be made. And what can the Federal Reserve do about it? There's only one thing they can do, and that is keep interest rates elevated, hike rates a little bit more, and then keep them there for a considerable time until you can get this number to moderate. And given that the number's only just turned over, that tells you there's a long road ahead here in order for it to get inflation under control, which means the world and the US are going to live with those elevated interest rates for a considerable time. So how much of the current inflation rate, if you take the 4%, I showed you US inflation has come down to 4%. What portion of that is now housing inflation? 69%, almost 70% of the current inflation rate, 4%, is due to one factor alone, and that's housing. And it just shows you how critical that factor has become. It tends to lag both into an upswing and downswing. And so it's going to take time, and that's the message. This is going to take time to get inflation fully under control. I think it will be brought under control. I think this number, I'm going back, but I think this number will move lower. I think by the end of the year, shelter inflation will be considerably lower than where it is now. And I think next year, you'll see the number move lower even still. And I think ultimately that will allow the Fed to cut rates. But until this number is down significantly, the Fed can't cut rates. They have to keep rates elevated to make sure that they get the inflation rate back to target. So that's where we find ourselves in terms of the biggest economy in the world. Now, what are the consequences? If you look at these interest rate hikes, this is aggressive rate hikes. Not the highest interest rates they've ever had, but it's aggressive. And we know that it should bring inflation down, but there's another factor we need to understand, and that is, what is the consequence on the economy, the performance of the US economy? Does it push the US economy into a recession? And the answer has to be, yep, there's a high chance it does that. Interest rates are designed to hurt. When you put rates up, they hurt. They hurt economies. They dampen economic activity. That's what you're trying to do. You're trying to slow things down, get inflation under control. So I think you've got to monitor that element as well. And obviously, if you're looking at investing just in the United States, you've got to be mindful of that, because obviously if the economy slows, goes into a recession, that's perhaps not a good time to put money into the US. And so you've got to evaluate that element. When you've gone through the recession and inflation's down, and then you start to cut interest rates, yes, then you want to be investing. But right now, you're trying to understand how much damage does interest rates do? How much damage is this going to inflict on the US economy? So let me show you where we are in that discussion. So the first thing is to look at the leading economic indicator. And the leading economic indicator has one job. It's created to provide one piece of analysis, and that is the US heading into a recession? That's what it's designed to do. And right now, if you look at where the number is, it's at a level that is signaling the US is going into a recession. Put it this way, every single time in the past, when the leading indicator has gone this negative, the US has had a recession. Is that a guarantee that we're going to have a recession in the US? No, it's not a guarantee, but it's not something you would just dismiss and ignore. You need to pay careful attention to this because it's telling us that that's where the economy is heading. The economy is slowing down and it could well go into a recession. And if it goes into a recession, we need to understand how big that recession is. How deep is that recession? How severe? And clearly, from an investment point of view, as you head into a recession, that's nervous time for markets. It's a brave person that becomes aggressive in terms of investing into a recession. Yes, once you've seen the worst of the recession, then you would be more comfortable investing. But right now, we got no idea where that is. We're still heading towards a potential recession. The difficulty with this, I think, is that the weakness in the US economy is not even across all the sectors. There's some sectors where the weakness is very evident. And I just want to illustrate that. And I'm going to show you the manufacturing sector in the US, just to illustrate where there is clear weakness. So the first thing is something called the ISM Manufacturing Index. It surveys manufacturing activity. Anything below the 50 index level is contraction. Anything above is expansion. And this number is now noticeably below 50, which tells you that manufacturing activity is contracting. Essentially, it's in a recession or heading to a recession. Are there other indicators around manufacturing that would tell us that there's pain in that sector? Absolutely. Look at employment in the manufacturing sector, the US manufacturing. So we're just going to look at the number of jobs being added to the US economy, the US manufacturing. And if you look at it, yes, they were adding jobs at a decent pace a year ago, 2 years ago. But more recently, if you look at that jobs data in the last, let's call it the last 5 months, 6 months, the numbers have been far from impressive. We've had a couple of negative numbers, and where they have gained some jobs, they've been much lower than previously. That's telling you, that's a signal that the industry, the sector is under pressure and it's heading weaker, and it may well go into a much more severe recession. So and if we delve into some other sectors, we'll find similar things. So there's parts of the US economy that are feeling the pain of higher interest rates and are weak and likely to weaken further. But it's not the entire economy. And that creates a dilemma. It creates a dilemma for investors, and it creates a dilemma for the Federal Reserve. The Federal Reserve would actually like, if all sectors were weakening, that would make their job very easy. All sectors are weakening, that would take the froth out of the US economy, inflation would come down quite sharply, and then eventually you can start to cut interest rates, and it would be an easy environment to manage interest rates in. But that's not what's happening. Right now, there are parts of the US economy that are weak, and then there are other parts where the weakness is not evident. In fact, they're quite strong. So let me just show you what's happening in the rest of the labor market. So US employment in total is at an all-time high. So yes, I showed you manufacturing is weakening, but it's a small portion of their economy. the bulk of the economy is a services economy, things like retail sales or leisure and hospitality, the film industry, the hotel industry, tourism, financial services. All of these sectors are huge in the US. And most of those sectors are holding up very well. And so total employment has fully recovered from COVID. You can look at employment during COVID. They lost 22 million jobs in 6 weeks, massive. And then they stimulated. Interest rates were pretty much taken down to zero. The government put a lot of money into the hands of households. Consumers spent, and the economy recovered. And employment recovered. But along with that recovery, obviously, you've got now the inflation problem. And so now you're trying to take this froth away. You're trying to actually hurt the economy. And when we look at the services part of it, the services sector is still adding jobs at a very decent pace. So look at the last, do the same thing, the last 5 or 6 months in the service economy in the United States. Geez, there's no sign of weakness, yeah. And so that creates a dilemma. It creates a dilemma for investors, a dilemma for the Federal Reserve. And so you kind of got to ask yourself the question, why are these sectors still holding on? And the reason seems to be that there's still pent-up demand for some of these activities. The impact of COVID was devastating. And we did some quite detailed work recently on how this impacted the tourism, the domestic tourism, the restaurant industry, the hotel industry. And what it turns out is that during COVID, obviously, a hell of a lot of that activity was canceled. People stayed at home, people couldn't go out, etc. Then eventually the economy gets opened up and people book holidays, they make plans. And so, yes, interest rates have gone up, but people have pent up demand to go on holiday. People have pent up demand to go to a hotel, to go to a restaurant, to go to a Disney World. And so those levels of activity are still quite buoyant. And they haven't been dramatically impacted by interest rates. And the problem is they need to be. They need to be to get inflation more firmly under control. And so it's another area we're focusing on, because if we start to see weakness in the services economy, weakness in service employment, then we become more convinced that inflation will go lower and that interest rates will be cut. And therefore, we become more convinced that we've got to look for the next upswing and the next investment cycle. But we're waiting for interest rates to have the desired effect. And so it's taking its time. We think it will have that effect. We think the economy will lose momentum across a range of sectors. But the message coming back from the data is this is all going to take a while longer. There's no quick fix here. Parts of the economy are weak. Parts of inflation are under control, but not all of it. And so interest rates have got to stay higher for longer, which means we're going to remain a bit cautious, a bit nervous for longer before we become aggressive in terms of investing in, say, the US market. The last indicator I just want to show you is on airline travel in the US. And it's one of those indicators. We get daily data on how many people are traveling on airlines in the US. I've got here monthly data because the daily data tends to look quite noisy, obviously. But it gives you an idea that there's no, while yes, manufacturing is heading into a recession, if you look at the number of people flying around the US, it's pretty much back at a record high. And if there is going to be a recession, this number will come down. So it's one of those indicators you can look at to say it'll give us an early signal that the economy is weakening more broadly. Business travel staying at home, people not going on holiday as much. And so if this number starts to weaken, it'll actually be good news, bizarrely. Good news because it says interest rates are working. Interest rates are doing what they're designed to do. The economy is weakening, inflation will follow lower, and you're getting closer to the point where you can start to cut rates and get on with the next business cycle. So unfortunately, we're doing this presentation in the midst of all of this. We're in the midst of waiting for these developments to unfold. We watch them constantly, and we're trying to evaluate, are we getting closer to the point where inflation is firmly under control and interest rates can start to be cut? And the answer is yes, we're moving in that direction, but we're not there yet. So that we think is only middle of next year. All righty, let's go over to SA. Now, the SA story, you can't discuss SA without discussing electricity. It's terrible now. You can't really talk about the economy moving forward until you're clearer on what's going to happen to energy supply. It's near impossible for an economy to flourish, an economy to become prosperous, if you're constantly facing a lack of electricity supply. Fortunately, I think we're moving in the right direction. I don't say that with a huge amount of confidence, but I'll try and illustrate why I think that we are moving in the right direction. So the first thing is obviously the number of days of load shedding. So I've got the calendar year for last year and this year, and every orange block is a day in which South Africa had load shedding. And you can see the blocks were colored in mostly the last 4 months of last year. Almost every day was load shedding. And then during the course of this year, pretty much every day, there was only one day in March where we didn't have load shedding. And I suppose you can guess what happened on that day. You could argue that it was some cabinet minister's birthday or something like that. That's why we didn't have load shedding. But the answer was that was when the EFF had their planned, I don't know what you would call it, national shutdown day. It was a flop. It was a disaster for them. It didn't achieve anything other than demonstrate how little support they do have. But the government made sure that there was no load shedding on that day. So obviously a miracle happened. We somehow had enough diesel. The power stations worked perfectly, and we didn't have load shedding. But other than that, we've had load shedding every day this year. And if you said to me, what do I think is going to be load shedding for the rest of the year, you would just color in every day, right? And I'm sure there might be 1 or 2 days where we don't, but it'd be impossible to know that. And so you just assume that there's going to be load shedding every single day. What has happened, though, is that during June, the extent of load shedding has been scaled back. And we need to understand why that's occurred. And in truth, we don't really know why. We've got some of the answers, but I don't think we've got all of the answers. So it's a little bit opaque as to why there's been less load shedding. What we do know is that the energy availability factor from Eskom has gone up. Energy availability is a fancy way of saying what percentage of their power stations are working, essentially. You've got a certain number of power stations that can produce capacity. If your energy availability factor is 100%, then all the power stations are working perfectly. Obviously, it's not 100%, it hasn't been 100%. And a little while ago, it got down to 50%. And in South Africa, that's a problem, and then you have severe load shedding. But if you look in June, the percentage has gone up from 53% to 59%, which, I don't know, that might not sound a lot, but in South African terms, that's meaningful. And what that means is you can scale back the load shedding because you've just got more electricity. Now, there are a couple of factors here. The first is that Eskom is doing less maintenance, and therefore you're not taking power stations offline to fix them or to maintain them, and so you've got power available. Now, that's not good news because potentially you should be fixing them and they're just going to break down in the future, and therefore delaying maintenance is not necessarily a wise thing. To be fair, though, Eskom typically during the winter months does reduce the level of maintenance to make more power available because the country uses more power during winter. So that isn't a big surprise, I guess, but it's not a big factor in helping the energy availability. It helps, but it's only a small contribution to this improvement. So where did the biggest contribution come from? Well, it comes from the fact that less stuff is breaking down. Less power stations are breaking. And if you say to me, why are less power stations breaking? I don't know. And if anybody's got insights, I'll be very keen to hear that. There are a couple of options here as to why less power stations are breaking. It could be that there's less sabotage, and we've got to know a bit about sabotage, and maybe there's been a move against people committing this type of sabotage, and maybe that's been effective. And so we break in less stuff. That's possible. I don't know. The second option is maybe we fix stuff properly. Maybe the maintenance we've done has actually worked, and that because we did decent maintenance, there's less breakdowns. That's an option. Is that the real truth? I don't know. It hasn't happened in the past. So why should it happen now? But it's a possibility. The third possibility, you just got lucky. In other words, we're going to have severe breakdowns. We're just going through a phase where we're just not having severe breakdowns. And we don't really know what the answer to that is. So the combination of doing less maintenance and less stuff breaking means we got more power. And then on top of that, the demand for power has gone down. Now, again, why has the demand gone down? A couple of reasons. One, people are investing in renewable energy, and so they're going more off the grid, not entirely off the grid, but they're reducing their reliance on the grid. And as a consequence, there's less demand. That's one factor. The other factor is we've gone into the winter tariff period for industrial users. They have to deal with winter and summer tariffs. And it's possible that some of the big industrial users have scaled back production because of the substantial increase in winter tariffs. So it could be they just purposely been a bit strategic on how they pay for electricity. That's an option. The third option could be the economy is just so weak in key parts of activity that we demanding less electricity. We're not growing this economy, and that weakness is resulting in less demand. So it's probably in truth a bit of all of that. But what it does mean is that we have less load shedding. No, not no load shedding, but less load shedding. Do I think it's sustainable? Well, I don't think it's fully sustainable because the maintenance levels will go up later in the year. And it's likely that some more stuff will break. But let's assume a couple of things here. Let's assume that the private sector continues to invest in renewable energy, which I think they will. I'll show you those numbers a little bit later. And let's assume that the 4 units that are out at Kusile Power Station, those are being repaired. And the plan is that those 4 units will be brought back online by the end of this year. Kusile 4 units come back. Medupi Unit 4, that's been broken for a while. Initially, they said it was going to be fixed by August next year. But from what I understand, they're trying to accelerate that repair, bring it back online sooner. The 1 unit at Kuiberg, that's been refurbished. And when that comes on stream, then essentially you're going to take the 2nd unit off for its refurbishment. So I'm not sure that's going to make a big difference until we get much later next year. But let's say that we bring back the 4 units from Kusile. Let's say that we repair the Medupi unit. And let's say that the private sector continues to invest in renewable energy. And I think all 3 of those assumptions are fairly realistic. It means we have less load shedding next year. Not no load shedding, but we have much reduced load shedding. And what that will do is give us an automatic boost in activity. Now, the Reserve Bank worked out that the load shedding we've been experiencing costs us 2% GDP growth. In other words, if we didn't have load shedding, you would immediately revise South Africa's growth rate up by around 2%. That's huge. So if we get to a phase where we have less load shedding, then some of that 2% will come back into the economy. It doesn't mean this economy would be fantastically buoyant, but it does mean that we probably have better growth than we have at the moment. And perhaps that starts to act as a catalyst to unlock further activity in South Africa. And I'm going to talk about that towards the end of the discussion. So I think at least the load shedding looks a little bit better. And then in 2025, 2 years out, I think we can continue on that and have no load shedding, because the private sector by then will have invested a lot more. There's some big private sector projects that are underway that will be completed by then. So I think that's a reasonable, realistic assumption. But it doesn't put us in a position where we've got lots of spare capacity that we can grow this economy at 4 or 5%. We're not going to have that sort of power within the next 2 years. But we could be in a position where we have a reduction in load shedding. All right, so where are we as a country in terms of our economy? We are essentially back to where we were before COVID started. We've tread sideways. Not a great outcome, but you could look at it more positively and say, well, given the extent of load shedding, you might have anticipated this economy having a much more severe negative reaction, a much more severe recession with lots of job losses. That hasn't really occurred. And so, yes, we haven't grown, but we're not in a recession. And so you end up having to conclude that this economy is actually fairly resilient. In the face of a lot of downward pressure, loss of confidence, load shedding, higher interest rates, concerns about the currency, high inflation, we're still not in a recession. Not a great positive to put forward, but there's a resilience. And I want to show you that resilience in retail, in shopping. So look at shopping in South Africa and look at the chart in the last 2 years. This is adjusted for inflation. And what you end up saying is pretty much this thing has gone sideways. Now, that's not great. You would need to see growth in the country. But the good news is it hasn't gone down dramatically. And if I think about all of the cost of living pressure, if I think about the employment pressure, all of those things, you might have anticipated these numbers being a hell of a lot weaker, but they've held on. And to me, there's a resilience there. And you see it in other areas. I'll give you one example, tax revenue collection. If we look at the VAT receipts, the personal income tax collection, those numbers have held up well. It's not just company taxes. If we look at the budget that was presented by the minister in February, pretty much most areas of tax revenue beat expectations. That speaks to a resilience in this economy. And I think that's good news, because obviously if you then start to get some things right and you're already resilient, then you could potentially have a decent base to grow off of. So I'm encouraged by the resilience. In terms of employment, I think you also seen some resilience. So let me explain what I mean. Go back to employment before COVID. This is formal sector employment. We were sitting at 10 million, 10.3 million people. COVID hits, and we lose a significant number of formal sector jobs. And then obviously, once we get past the worst of COVID, we try and get those jobs back, but we haven't been able to add those jobs back. But what I'm encouraged by is that this number hasn't gone below those COVID levels, that it hasn't declined even further, that companies haven't said, well, there's load shedding and I'm spending a huge amount of money on diesel and I just can't afford this and I've got to cut and I've got to close down and we've got small business failures, in which case the jobs numbers would be a hell of a lot lower. And I'm not saying the job numbers are great, they're terrible. The unemployment rate is shocking, but there is a degree of resilience within this. And it comes about because companies don't have excess staff. Companies are not sitting with a bloated labor force. So if the companies say, well, I'm going to cut jobs, then they're probably going to close a department. That's a bigger decision. And companies don't want to make that decision. So companies are treading water, waiting for things to get better. Obviously, the longer it takes for those things to get better, eventually you can't hold on any longer and you're starting to close departments. And that would be problematic for the economy. But right now, there is a resilience being demonstrated by South Africa's corporate sector. Their first thought is not, let me cut, let me close down, let me scale back our operations. They're not doing that. They're also not disinvesting. They're not selling up their business and moving offshore. They're holding on, adopting a wait-and-see approach. But it does mean that from a standard of living perspective, we're not going forward, right? And I need to explain quickly why this has come about. This has come about because the population in South Africa grows at 1.3% a year. And what that means is 600,000 people enter the labor market every year. So in order for the economy to absorb the population, this number I've showed you previously, this has to grow by 600,000 every year. And obviously it's not doing anything like that. And so a huge number of people can't be absorbed into the labor market. Many get absorbed into the informal sector in different ways, but ultimately their lifestyle is disappointing. They have problems affording houses, cars, overseas trips, clothing. The things that make lifestyles good, they struggle to afford that. And so South Africa, from a cost of living perspective, is going backwards when you look at it in its entirety. So let's finish off this and ask ourselves, so what's the way forward here? And I want to make this point very clearly. I've been in a couple of presentations with government recently. And it's been frustrating because my view is that many government departments, government entities are looking to blame. They're looking to blame things, but they're not willing to take responsibility themselves. And so I thought, let me delve into this a little bit and see if I can make this clearer. And so unfortunately, this might sound a bit harsh, and I'm not trying to be political, but government has to own the responsibility, and I'm going to demonstrate why. So if you look at government debt in South Africa, it was sitting at 45% more or less when Trevor Manuel took over in 96. Trevor Manuel became Minister of Finance in 96. He was sitting with a fairly high level of debt. People thought he would mess up, he didn't. And ultimately he took government debt down to 23% in 2008, 23%. Remarkable, absolute miracle. At that point, South Africa is an A-rated country. Moody's gives us a credit rating A. And at that point, the South African government can spend money on anything they want. 2008, 2009, the government could spend money on whatever they wanted. All they had to do was decide what they wanted to spend the money on. That's it. Nobody would have complained. You want to build a road, a harbor, you want to build a school, you want to build whatever. You've got the money, your debt level's incredibly low. Just decide what you want to spend the money on. And so the government decided to spend the money. And they spent the money and took government debt up to 70% of GDP. The problem is they wasted that money. They didn't spend the money appropriately. They didn't spend the money on infrastructure, on things that would lead to job creation. They squandered a lot of that. They corrupted a lot of that. And then the rest of it they spent on consumption-related, salaries and wages. And so the efficiency of that spending is atrocious. So I just want to give you what that means from 2010, right? You can see this chart deteriorate from 2010. How much money are we talking about from 2010? Government spent all of the tax money they collected. How much was the tax money? 15.3 trillion rand. So from 2010 up until this year or last year, 15.3 trillion rand in taxes that you collected. That money's all been spent. On top of it, government took on 4 trillion rands worth of additional debt. You put those two numbers together, you're getting close to 20 20 trillion rand. The government has spent 20 trillion rand since 2010. And what did you get for that money? What did the country get? The country spent this money. What did the country get in return? Let's have a look at the list. The country got a 5.6% decline in income per capita. In other words, lifestyles went backwards. The unemployment rate went to 32.9%. Incredible. The credit rating went to 2 notches below investment grade. We got grey listed. We got persistent electricity outages. We've got a Durban harbor that is ranked the 6th worst in the world out of 370 harbors. We've got a fragility index, which is now elevated warning. The next stage is failed state. We ranked 131 out of 141 in terms of corrupt countries. More than half our municipalities are insolvent, and we've got the 3rd highest crime rate in the world. And we got that for the cheap price of 20 trillion rand. That's the problem. You took a balance sheet which was remarkable. You took a level of government debt which was astounding, by global terms, an absolute miracle. And you only get that chance once in 100 years, or even less than that. And we took that golden nest egg and we squandered it. We blew it. We blew it. We had a big party. Now government debt sits at over 70% of GDP, and the minister has to try and control this. And government cannot now start to just simply spend money on things we really do need, the infrastructure. There isn't the money. So that ends up with a dilemma. What's the solution for South Africa? There is a solution. It's an obvious solution. It's not necessarily the solution the government wants, but there's a solution, thank goodness. And what is the solution? When you do the same thing for the corporate balance sheets, incredibly well managed. Corporate debt relative to other emerging markets, extremely low. This is the latest data, and we have one of the lowest indebted corporates in the world. And the bizarre thing is the number that you see on this chart for corporate debt. That includes the SOE debt of South Africa. That includes Eskom debt, Transnet debt, post office debt. All of that is included in this number. You take that number out, and private sector corporate debt is incredibly low. Private sector corporates, conservatively managed, sit with a decent amount of cash, sit with a good balance sheet, sit with a decent amount of expertise. And in order to gain success, all you've got to do is get that balance sheet to work, get that balance sheet to invest, get that balance sheet confident, and grow the economy. That's it. And then you've got a vibrant economy. The difficulty is that in order to do that, government has to get out of the way. And getting out of the way is not so easy, right? Ideologically, it's not what government wants to do. In terms of voter support, probably not what people want. So it's not so easy. But that is the solution. Now, I want to illustrate how this can work quickly. So where did government get out of the way? Well, they got out of the way on the energy side, right? They got out of the way once energy got to a crisis, and they said, now you can build any projects you want in terms of renewable energy. We're not going to cap the size of those projects. You can build whatever size project you want. And within a very short period of time, those projects have gone registered on the NERSA website just this year alone. First 5 months of the year, 2,750 megawatts registered. And those projects continue to increase. In other words, the private sector saw there's a problem. The private sector balance sheet responded, and there's a whole lot of investment projects that are lined up that are going to continue. And there's going to be more beyond this. And so when you're worried about water, the answer, get the private sector involved, private-public partnerships. It doesn't mean government has to give up control, give up ownership, but it does suggest that government has to partner with the private sector, get private sector balance sheet involved, get private sector expertise involved, and get the functioning of the South African economy a hell of a lot better. You do that, and I think you then got the makings of an economic upswing. Does government know this? Yes. Are people working towards this? Yes. So the people in the office of the presidency, that's what they were set up to do, is deregulate South Africa, allow the private sector in. And they're making progress. And it's one of the reasons I'm more encouraged, I'm more optimistic, because they are now giving quarterly updates on what their progress is. And the last quarterly update I had, I thought, geez, you're making good progress here. Yes, it's not being covered that well in the press. It needs to be more known. But systematically, some of these things are moving in the right direction. You take together the development on the energy side, you take together inflation coming down, interest rates coming down next year, and you've got the makings of an economic upswing. An economic upswing that is not fantastic, that is not as good as what we need, but it's better than what we've had. And in that environment, given how cheap South African assets are, I think you'll see South African assets perform positively. So I'm more optimistic, certainly for the next 2 years beyond this year. So I'm just going to flick over to this chart to show you. So this year we've got growth of less than 0.5%. That's pathetic. The next 2 years beyond that, I think the growth rate picks up more meaningfully. What growth rate makes a difference in this country? You've got to get the growth rate up to 4%, 5%, and keep it there. That makes a difference. That allows us to absorb the number of people that are entering the labor market. So the growth rate you see on this chart as a forecast, that's not good enough. That's nowhere near good enough. But perhaps it's the start of some improvement that we can build on. If there is a willingness within government post the next election to try and implement reforms that encourage the public sector to partner with the private sector to benefit the country more broadly, that's our only road to success. If this is a government go-it-alone strategy, it won't work. Government doesn't have the balance sheet, nor does it have the expertise. It won't work. The only road to success is to partner with the private sector that has the expertise and has the balance sheet. It's possible, but the politicians have to be willing to embrace it. All right, I've gone over time. I apologize most profusely. I don't know if there are any questions.
So Kevin, we had one question. Do you have any idea what the time lag is between rising interest rates and the impact on the economy? And maybe the rapid rise in rates will overshoot the reduction in economic activity.
Yeah, so it's possible that you make a mistake. Central banks make mistakes all the time. So when you do the analysis, the full effect of an interest rate hike takes more or less 18 months in South Africa and actually in most countries, 18 months. So that doesn't mean that interest rates don't work immediately. They start to work straight away. But the full effect of interest rates takes months. And that's the problem for central banks, because you're hiking rates now, but you don't know the full effect until much later. And so you're trying to judge, how many rate hikes do I have to do, hoping that I've got the right sort of measure in place. And you could overshoot and you can undershoot. So you could potentially already have tightened interest rates too much and then only see that during the course of next year. You just don't know it. That's entirely feasible. When you put that dilemma to the Reserve Bank or to central banks, their response is, yes, that's a risk. But if we see that happening, we can cut interest rates very quickly. So we can start to mitigate the damage we've inflicted, and we can do that quickly. And so they're not as anxious about over tightening rates. They've been more anxious about not tightening rates enough.
All right, so thank you very much for the valuable insights. We are cognizant of time. So I think if we can circle back now to the poll that we put up, the first two questions that we raised, I think we have a quick chat around that, and then there's two other questions we'll do. So the first one was, what concerns you most about at this point in time? And that was the 2024 elections, with roughly a third. Surprisingly, a weak currency being on the lower end, market returns as well. And then the biggest contributor was infrastructure. So as you sort of outlined, and I think one of the questions was infrastructure, you said the PPPs are working. We're seeing, that this engagement with government is happening. The water potentially, electricity, the split now between the distribution side of Eskom and that being managed as a separate entity, that bodes now well for the South African economy. So I think the next question, and one that we've seen now, is with this Pier 2 harbour down in Durban. and the potential privatization. Is this a view that you have, that with these PPPs, if the harbor is a success story, that this will then feed into water, road maintenance, etc.?
Yes, so the last engagement we had with the president's office, they said that the preferred bidder for Pier 2 Harbour will be announced next month. So the private sector has been asked to bid. And what you're bidding for is they're not giving up ownership. All they're doing is giving up the management or the running of Pier 2 Harbour, not the whole of the Durban Harbour, just Pier 2, which is the container port. They're giving that up in terms of running it to the private sector. And what they've said is if that proves to be a success story, then they'll do the same thing for the other harbours. And hopefully that then improves the efficiency of those harbours, in which case you would argue that improves productivity, it encourages confidence, fixed investment, people are more willing to use the harbours. There's lots of benefits of doing this. And hopefully government is learning from these exercises and rolls it out into other infrastructure.
Okay. The second poll was, how do you feel about South Africa in the next 5 years? And a third of the respondents were negative, I think, and then roughly the majority was for a neutral position. So I think you've painted a better picture, and we've kind of highlighted what are the potentials now that can happen over the next period of time. So I think maybe in summary, are you feeling optimistic? And then I think second to that is, what is your biggest worry at this point in time?
So yeah, I'm more optimistic than I've been. And I think we're at that inflection point where you're at the point of maximum pessimism. I think there are a number, it's not based on one thing. It's not based on, oh, there was slightly less load shedding in June, so I'm more optimistic. No, I think it's more substantial than that. Also, it's not going to take a lot to get the environment looking better. It's off a low base. So I'm more encouraged. But I need to stress that encouragement is just for the next couple of years, where I think we can improve relative to that low base. Once we get that improvement, there becomes a bigger question, and that is, are we able to make the larger structural changes required to lift South Africa's growth rate beyond 1 or 2%, get the growth rate to maybe 3%, 4%, see if we can sustain that. And so if you say to me, what are the biggest risks? There are a couple of them. One would be that private sector business, which has a very good balance sheet and has been committed to South Africa, that let's say they lose confidence entirely. They decide prospects are elsewhere. I've got to more and more close down businesses and shift my balance sheet offshore. And at the time when you want to use the private sector balance sheet, it's not there. And it's gone away. It's gone to Australia or somewhere. That would be a significant risk. And then the other risk is obviously, we get into an election next year and we end up with a coalition that's messy, and it keeps breaking down, and we can't get any of these initiatives to gain further momentum. And so the reform stalls. The reform is there, but it's fragile, right? There is reform. Cyril did implement some reforms, but it's hardly convincing, and it's piecemeal, and it needs more support. And there are elements moving in the right direction, but you needed to gain a lot more momentum. And if you now change the politics and you disrupt those reform initiatives, then you'd feel, well, we're making no real progress, in which case the structural impediments remain problematic.
Spot on. So I think, the politics is always a messy one. I think as a business, we want to engage a political analyst later in the year, closer to the election. Ian raised a question and asked, do you predict that the new NHI bill will influence the economic growth within the country within the next decade?
So NHI is unaffordable. You're trying to introduce a NHI in a country with 30-odd% unemployment, with an incredibly low, small tax base, with a dysfunctional public health system. It's a non-starter, but that doesn't mean that government doesn't try and force it through, and therefore potentially, further discourage initiatives within the healthcare market. And what that will do is it will be another factor that people will look at and say, well, maybe I need to disengage from South Africa. So when we look at those factors, think about it. People have left because of electricity, water, sanitation, worried about education. Now you throw in healthcare. It tends to then dampen down your willingness to invest in this country for the future, etc. And so I'm hoping that government sees that this is ultimately not a viable prospect, and that you're better off trying to at least the money that you do spend in the public healthcare, try and get that a little bit more efficient than it is at the moment, and then work off that base. But the way it's put forward at the moment, it would be a huge disaster for South Africa.
Perfect. In terms of what we've seen publicized now and this AGOA agreement, and thank you, Trevor, for the question, do you think there is some weight behind this? Are we going to be able to dodge this Putin scenario, and particularly what we saw now over the weekend with this mini coup? And Wagner, what is the impact of AGOA? And further on to that, the second question is Trump. If he's re-elected, how does that paint a different story for you in terms of the US?
Yeah, so AGOA it's a symbolic type of agreement more than a massive boost for South Africa. We derive some benefit from it, but not the benefit that was envisaged. So if you think about 8% of our total exports go to the United States. So it's not, the United States is not the biggest market for us. The biggest market is Europe and then Asia. And the growth in our exports has been very much Asian based. So 8% to the US, that's still important, but it's not the be all and end all. And then what portion of that 8% qualifies for AGOA? It's about 25%. So if you remove AGOA, you are going to directly impact 25% of 8%.
Yeah.
And that doesn't mean you can't export. AGOA is not a sanction if you take it away. It's not sanctions. It just says this preferential access that you had where you can export duty-free to the US. We're taking away that preferential access. You can still export, but then you're asking US customers to pay for your goods plus duties. And will that hurt our competitiveness in the US? Yes, and it might hurt our exports. But in the South African context, it's not a disaster. What is more problematic is the message it sends. The message would be that South Africa is now moving outside of being on sides with the Western alliances, on sides with NATO. And there's a lot of business we do in Europe. There are a lot of companies that may decide on their own, do we really want to do business with South Africa? And you may find that given ESG, social responsibility issues in Europe and the US, that companies decide on their own, I don't know if I want to do business with South Africa, given the association with Russia and the supply of arms. So to me, it's the signal that it sends that is more important. A Trump regime, I think, look, Trump would probably look at it a little bit more favorably than perhaps the Biden administration in terms of AGOA. I think no matter which administration, I think there's a very, very low chance of sanctions against South Africa. We'd have to do a lot of other stuff to get sanctions, and I don't think we're at that point. Trump wasn't really good, though, for the US-Africa relationship, and I don't think that necessarily changes if he's in power. So I'm not sure that there's a significant uplift for South Africa if he's in charge, but it would lessen the prospects of us being impacted by the removal of an AGOA or something like that. So I think it's at the margin. To me, what's more important is this thing is going to come up for review. The AGOA agreement comes up for review. And at that review, it's quite easy. The president of the United States can make a decision and simply exclude any country from that. He doesn't need congressional approval or any other major thing. And so there is a vulnerability, and if that happens, that will catch their news headlines, and sentiment-wise, that's not good for us.
Okay. All right, so I think let's wrap up with one last question. If we can, please just bring up that slide in terms of Russian oil. So what we saw in this, what this slide demonstrates is, Europe was the main purchaser of this Russian oil prior to the invasion. And what you see now is that this has now been taken up by India. So Kevin, is this a case of India's growing, they're putting the right things in place, they're absorbing this oil now? Are they using it purely for themselves, or is this now going to Europe as well?
So I think that these markets are quite opaque, right? Because I think when it comes to sanctions, you're never sure on who is the end user, who's the end customer. When we look at the performance of Russia, and we first look at the type of sanctions, the breadth and depth of the sanctions that were implemented or announced by Europe and the US, and then we look at the performance of the Russian economy, it tells us the sanctions are largely ineffective, that there's a lot of ways in which these sanctions are being worked around, and that, to say this is the end user of this, that's difficult to say at this stage. What is becoming clear is that the world is becoming more fragmented, and the fragmentation is centered partly around BRICS, partly around Russia and China, and that fragmentation, I think, is longer term more problematic for global growth. It doesn't help, and also many countries are being forced here to choose sides, and whoever you choose has a big implication. Ideally, you want to remain neutral in all of this. And that's the stated position of South Africa, although we're far from neutral. And so we kind of hooking our wagon, if you like, to the China, to BRICS, to Russia. I don't think that's ideal for our longer term prospects. I think we'd be better suited to be neutral because of the importance of Europe in our trade relationships. But I think the world is becoming more fractured, and that tends to then hurt longer term growth.
Spot on. All right, Kevin, we're exceptionally grateful for your presentation today and for your valuable insights and for presenting to our clients, and to our clients that have attended. Thank you to everyone for attending and for your continued support. As a business, we remain committed to you and through our advice process and manager selection. If there are any questions that do come up, the presentation will be made available as well. Please just drop us an email or a message, and we'll then personally get in touch to address those questions. So we thank you for all your time today. If we may ask, please, that we have 5 questions just post the webinar, and that's to enable us to get some feedback from you as the audience, how we can improve these types of engagements going forward, and things that you'd like to see. And again, thank you everybody for attending today. Kevin, thanks again.
Thanks, guys. Go well, eh?
Cheers. Bye-bye.